In order to successfully trade options, we need to know what to trade, when to trade it, and when to close it. Let's do it right now. We enter our ticker, we select our strategy, we select long or short. For earnings handling, for now we will do nothing special. For our backtest length, we will select 2 years, and we will trade weekly options, that's every 7 days. If we wanted to do monthly options, we would enter a 30 here. And here are the results. First, you'll notice the layout, moving from left to right. We go from in the money to at the money to out of the money. Now let's start our analysis. It looks like selling a put spread in Apple for the last 2 years, every 7 days, has been a loser across the board. And this is where 99% of traders stop. They assume that selling a put spread in Apple has been a loser. This is where they're wrong and you're right. Let's remember this negative 21.3%. That's where we're starting. Now what we'll do is go to earnings handling, and we want to avoid the risk of earnings. And we do that by clicking one button. When we select never trade earnings, that means the backtest will close the position 2 days before earnings, let earnings occur, and then reopen 2 days after. Let's select never trade earnings. Things are still negative, but they're getting better. Remember, this was a negative 21.6% return, and now we've got it down to negative 10%. Still a pretty bad strategy, but we're not done. Next, we come down to our close trade when section. This is where we can put limit gains and stop losses on our option trades. In this case, let's make it so that anytime our short spread loses 100%, we simply exit the position and we'll trade again next week. That is, we're going to avoid any catastrophic losses. We simply type in 100 and then click outside the box. Notice that everything is now positive, and our out of the money put spread, which started as a 21% loser, then went to a 10% loser when we avoided earnings, is now a 68% winner when we have the correct stop loss. And we can go even further. While this worked over 2 years, it's a fair question to ask, has this worked over the last year? We simply click a button, and now here are the results. Everything is triple digits, and our out of the money put spread is a 182% winner. If we want to see how this compares to the stock, we come down to the charts. Each colored line represents the color of the tile for each backtest. We can unselect everything other than the one we're focusing on, and we can see very clearly that the backtest is up 182%, while the stock was up 39%. Now, to see the details of a backtest, you simply click on a tile, and here we can see the 182% win. There are 38 winning trades and 12 losing trades for a 76% win rate. We can see how the 182% did relative to the stock, which was up 39%. We can even see our total commissions paid. Even further, we can come down to the trade section, which lists every single trade we did in the backtest, when we were stopped out, when earnings occurred, and when we rolled the trades. You can copy and paste all of this information into Excel if you want to examine further. If you want a reminder of what a delta is, you simply click on what is a delta, and we go step by step with great specificity describing what a delta is, why it matters to backtesting, and you'll see now that there's no magic here. We took a trade that looked like an obvious loser and turned it into an obvious winner by taking less and less risk. We removed the risk of earnings. We removed the risk of a catastrophic loss by putting a stop loss, and all of a sudden we found a winning trade. Now let's turn the tables and look at an aggressively bullish strategy on Apple. We will look at owning calls and doing nothing special with earnings, trading over the last 2 years with the weekly options. But now we're going to go to our settings. We're going to buy a 10 lot of calls. For execution fill type, if we did market price, that is buying on the offer or selling on the bid, that's likely too pessimistic. We can do better than that. But if we went mid-market, that's likely too optimistic. The most realistic facility for an option backtest is to trade halfway between mid-market and market. That is, we sell closer to the bid but not on the bid, and we purchase closer to the offer but not on the offer. Here is where we enter our custom commissions, and this time we're going to select our custom deltas. I really want to focus on the at the money call, that is the 50 delta. Then we hit save, and here are the results. We'll focus on the 50 delta call. We can see that owning the at-the-money call for 2 years, rolling it every 7 days, returned 55.8% in Apple. Let's go back down to our closed trade when section, and let's put a stop loss of 50%. That is, anytime we hit a call that loses 50% of its value, we're going to close it, wait for the next week, and trade again. And now the results are even more astonishing. We went from a 55.8% return to more than double that and took half the risk. And if you're feeling a little bit like Alice falling down the rabbit hole in Wonderland, don't. All we've done here is selected a strategy, tested earnings, tried a stop loss, and found our results. And we can do this with any stock or any ETF and find equally strong results with just the click of a few buttons. And now we know the real secret, friends. There's a lot less luck and a lot more planning to successful option trading than almost everyone realizes. And it's not about guessing which stock will go up or down. Now it's your turn. Be powerful.